Hey there. So this is Mia. She just landed in Tokyo with 1,000 US dollars. At the exchange counter, she gets back 162,000 yen. 162,000. She feels rich. 2 weeks later, she lands in Kuwait, hands over the same $1,000, and gets back 306 dinars. 306. She feels broke. Same money. Same person. So who's actually rich here? Read the numbers and you'd say Kuwait's money is worth 500 times more than Japan's, meaning Kuwait's economy crushes Japan's. That's insane. So what's really going on? Why is $1 worth 162 yen but only zero point 0.3 dinars? Who picks these numbers? Can a government just decide what its money is worth? And most importantly, what does any of this mean for the money in your pocket? And stick around because one of the currencies I'm about to show you is kept weak on purpose by its own government, and it's not the one you're thinking of. In this video, we'll cover everything you need to know about why currencies have different values. So let's get started. Section 1. The zero illusion. Before anything else, we have to kill the biggest myth in this topic. And I mean kill it because almost every video you've watched on this got it wrong. The myth is a high number means a strong country. Expensive currency, strong economy. It doesn't. Not even a little. Here's the proof. The Kuwaiti dinar is the most valuable currency on earth. One dinar buys about $3.26. Impressive. Now the US dollar, $1 buys only $1. So by that logic, Kuwait beats America. Except the dollar sits on one side of 89% of every currency trade on the planet and makes up almost 57% of the world's reserves. The dinar barely circulates outside Kuwait, hard to convert, and its economy lives and dies on oil. The dinar isn't expensive because Kuwait is 3 times better than America. It's expensive because back in 1961, Kuwait picked that number. Somebody chose it like a password. Think about a Big Mac. In Switzerland, it costs about $9. In Taiwan, about $2.50. That gap tells you something real. But whether you hand over 8 francs or 80 or 8,000, nothing. So why do some currencies have so many zeros? History, plus something called redenomination. When inflation goes crazy, the numbers balloon. So the government just deletes zeros. In 2005, Turkey wiped 6 zeros off the lira. Before, 1 euro cost 1.8 million lira. After, 1 euro cost 1.8 lira. Nothing about Turkey changed. Same economy, same factories, just shorter price tags. Zimbabwe did it harder, 10 zeros in one go in July of 2008, when their money traded at 110 billion per US dollar. Venezuela cut 5 zeros in 2018, then came back for 6 more. That's not a currency. That's a subscription. And some countries went the other way. South Africa, Australia, New Zealand, and Nigeria actually added digits, specifically to make their numbers look closer to the dollar. They engineered it, on purpose. Which brings us to that currency I promised. Vietnam. $1 gets you about 26,000 dong, and Vietnam is on every weakest currencies list online. But Vietnam isn't collapsing. It has kept the dong weak on purpose since the 1980s. Cheap money means cheap exports, and manufacturing is now a quarter of the economy. Not a disaster. A strategy. Same list, completely different stories. The number is a costume. Which raises the real question. If the number is arbitrary, who set it in the first place? Let's go find them. Section 2. Where the number even came from. For most of modern history, this was easy because money was just gold with extra steps. In 1944, with World War II still burning, delegates from 44 countries met in a hotel in Bretton Woods, New Hampshire. Their job, build a money system that couldn't collapse into the chaos that helped cause the Great Depression and the war itself. The deal was beautifully simple. America pegs the dollar to gold at $35 an ounce. Everyone else pegs to the dollar. Japan locked in at 360 yen, hand the treasury $35, walk out with an ounce of gold. The dollar was literally as good as gold. And for 25 years, it worked, but America kept spending. Foreign aid, military bases, Vietnam, dollars piled up abroad faster than America mined gold. Kennedy tried to fix it, Johnson tried. Nothing worked. And look at the receipts. At its peak, America held nearly 20,000 tons of gold. By August of 1971, about 8,584. Countries were quietly cashing out, and everybody could see the vault emptying. So on August 15, 1971, Nixon went on television and closed the window. No more gold. One sentence and the anchor holding the world's money in place dissolved. Europe and Japan weren't even warned. They woke up to a brutal choice. Let their currencies float up and make their exports expensive, or keep buying dollars and import America's inflation. That's the moment the exchange rate stopped being a rule and became a live, moving price. And how did that work out for gold? It went from a fixed $35 an ounce to $4,686 in April of 2026. Measured in gold, the dollar has lost roughly 99% of its value in about 50 years. So if nothing backs the money anymore, what sets the price? Turns out there are 4 forces. Let's break them down. Section 3. What actually moves the number? Force number 1, and by far the biggest, interest rates. But not the way you think. The Bank of Japan's rate is 0.75%. The Federal Reserve's is 3.5 to 3.75%. So investors borrow cheap yen, sell it, buy dollars, and pocket the difference. It's called the carry trade, and every one of those transactions dumps yen and buys dollars, millions of times a day. Which brings us to the best example in modern economics. Open any textbook. Strong economy plus trade surplus plus rising rates equals strong currency. Japan is doing all 3. Record current account surplus of about $219 billion. The Bank of Japan raised its rate to 1% and signaled more. Japan even burned about $73 billion buying its own currency back. The yen should have rocketed. Instead, in June of 2026, it hit a 40-year low, the weakest since 1986. Why? Because Japanese companies made all that money abroad and just left it there. Japan's investment position outside the country hit a record $3.5 trillion. That money never came home, never got converted into yen, never created demand. So a country did everything right, spent $73 billion fighting for its own money, and lost. Because the market doesn't trade how good your economy is. It trades where the yield is right now. Force number 2, trust. Trust isn't a slow burn, it's a cliff. For over 25 years, the Lebanese pound was locked at 1,507 per dollar. Rock solid. Then the banking system cracked in 2019, capital controls slammed shut, and confidence evaporated. Today, $1 buys about 89,500 pounds. A currency that didn't move for a quarter century fell almost 60 times in 6 years. Nothing changed about Lebanon's geography. Everything changed about whether anyone believed it. Force number 3, politics and sanctions. And this one breaks the whole idea of the exchange rate. Iran's central bank publishes an official rate of about 42,000 reals per dollar. Walk into a Tehran market and the real rate is around 1.65 million. That's not a typo. The official price is roughly 40 times off. Same currency, same country, same afternoon. So when someone tells you the exchange rate, always ask, whose? Force number 4, habit. And here I have to break some bad news. You've heard of the petrodollar. The story goes, in 1974, America struck a 50-year deal forcing Saudi Arabia to sell oil only in dollars. And in June of 2024, that deal expired, so the dollar is finished. That's fake, all of it. In June of 2024, the story exploded online. Google searches for petrodollar spiked to their highest level on record. Trace it back, though, and the sources all cite each other in a circle, and at the bottom of the pile is an anonymous post on a website nobody's heard of. There was never a formal 50-year oil for dollars agreement to expire, which makes it very hard for one to run out. What was real? Kissinger built a web of understandings. Security for Saudi Arabia, Saudi money into US Treasury bonds. That stayed secret until Bloomberg pried it loose in 2016. So the dollar's grip on oil isn't a contract, it's a habit. Everybody prices oil in dollars because everybody else does. And that's scarier because you can cancel a contract. You can't cancel a habit. So there it is. Rates, trust, politics, habit. That's the whole list, and every currency move you'll ever see is some mix of those 4. Which raises the obvious question, if the price is this messy, can't a government just pick a number and be done with it? Section 4. Can you just decide what your money is worth? Kind of. The IMF sorts every country into 8 categories for this, and 26 run what's called a hard peg. Let's go through the menu. Option 1, the nuclear option. Give up. 11 countries use the US dollar and threw their own currency in the bin. Panama in 1904, Ecuador in 2000 after the Sucre collapsed, El Salvador in 2001. Panama's version is hilarious. They technically have a currency, the Balboa, but they only mint coins. Every banknote in Panama is American. The cost? Ecuador killed inflation and killed its ability to ever run its own monetary policy again. There's no undo button. Option 2, the currency board. Hong Kong has locked its dollar between 7.75 and 7.85 per US dollar since October 17th, 1983. And it works. But understand the cost. Hong Kong's monetary authority doesn't really set interest rates. It mirrors the Fed. Every time Washington moves, Hong Kong's mortgages move, whether Hong Kong's economy wanted that or not. And defending it is a street fight. In 2025, money poured in and slammed the currency into the strong edge, then reversed and hit the weak edge. And the authority had to buy 86.93 billion Hong Kong dollars to hold the line. Same year, both directions. Option 3, and this one's wild. Let someone else own your money. 14 African countries, 227 million people use the CFA franc. It's pegged to the euro at exactly 655.957, guaranteed by the French Treasury. The banknotes are physically printed in Chamalières in France. Central African members still deposit half their foreign reserves with France. They've been promising to replace it with a currency called the ECO for years. It's 2026. The peg is still there. Defenders say it delivers real stability and low inflation in a genuinely volatile region, and honestly, they have a point. Critics call it a colonial relic. Both sides are staring at the exact same 655.957. Option 4. Manage it quietly. China sets a daily reference rate and lets the yuan move 2% either side. When Beijing wants to move the price without fingerprints, state banks do the buying. But here's the twist. Everyone knows China keeps the yuan artificially low, right? The US Treasury's January of 2026 report found the People's Bank actually sold $84 billion buying yuan, propping it up. Treasury refused to label China a manipulator and mostly complained that nobody can see what's happening. So the story you've been told is at least one chapter out of date. Okay, governments can pick a number. But can they defend it? Because there's someone on the other side of that trade. Section 5. When the market breaks the government. September 15th, 1992. The head of Germany's Bundesbank makes an offhand comment to a journalist that one or two currencies might come under pressure. Traders read that as, the pound is dead. Next morning, George Soros scales his bet against the pound from $1.5 billion to $10 billion. The Bank of England is legally required to buy every pound thrown at it. Speculators throw faster than it can catch. Britain burns over $22 billion of reserves in hours, then surrenders. Cost to Britain, £3.3 billion. Soros made over $1 billion in a day. The punchline? Britain ended up better off. A cheaper pound and lower rates fueled years of growth. The market was right and the government was wrong. January 15, 2015, Switzerland had promised to hold the franc at 120 per euro. It abandoned that promise with no warning. The franc jumped about 20% in minutes. Traders, funds, and exporters were vaporized before lunch. And Zimbabwe. In April of 2024, they launched the ZiG, backed by actual gold, their sixth attempt at a currency since 2008. On September 27th, it went from 14 to 24.4 per dollar, a 43% devaluation in one day. Real gold in the vault, and it still broke, because gold in a vault is not the same thing as trust in the street. Today, 80% of Zimbabwe just uses US dollars anyway. Now, some of you are thinking, fine, but those are small countries. Big economies control their own money. Tell that to Japan. $73 billion, spent, gone, 40-year low. Here's the number that explains all of it. The currency market trades $9.6 trillion every single day, bigger than the global stock and bond markets combined. No treasury on earth has that ammunition. Governments can suggest a price. The market decides if it agrees. So, in conclusion, currencies don't have different values because some countries are better than others. The number on the screen is an accident of history, plus a live bet on rates, trust, politics, and habit, updated a few million times a second. Kuwait's dinar is expensive because of a decision in 1961. Vietnam's dong is cheap on purpose. Japan did everything right and still hit a 40-year low. Lebanon's number didn't move for 25 years, then fell 60 times over. It's not about the number, it's about who believes it. And that's the thing about Mia. In Tokyo, she felt rich. In Kuwait, she felt broke. And she had the same $1,000 the whole time. The money never changed, only the story around it did. Now, you're probably wondering how traders actually profit from these swings. Or what happens when a country's money dies completely. That's for another video because we're out of time. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.